Well, what I'm going to do, last week I went through fairly rapidly the logic about why endogenous money changes macro in a very fundamental way. And I realized that I've got to, I tend to, because I'm used to all this stuff and I developed myself, it's obvious to me. I know that it's not to a lot of people. So I'm going to hit you with two more variations on that same logic today to try to explain why the endogenous money makes such a big difference. And the whole idea of financialization comes out of that. And two more, and also a bit of a small amount of literature. I'll do more in a future lecture on this. But why did it take so long for Post Keynesians to start properly integrating endogenous money into macroeconomics, even though there's been about 40 years of detailed work into saying, look, the model of money that Neoclassicals use is just structurally wrong. That's not how lending is done. And then some of the final part of the lecture, I'll go to the empirical data on endogenous money. And the basic point I made to you last week, but I want to hammer that a few times today, so I hope you get the logic more thoroughly, is that aggregate demand is the sum of the turnover of existing money plus credit. And the first bit is standard velocity of money argument, which you'd find in Milton Friedman. But the plus credit is the part that comes out of seeing money as endogenous. And what I did last week, and I'm going to do this several times today just to try to get the point through, is say, let's divide the economy into three arbitrary sectors. That could be investment, consumption, and speculation. Okay, investment, finance, and asset markets. It's quite possible to think about it that way. And then you look at expenditure by one sector on the other, and that's a flow of dollars per year, the amount of money they're spending. So the aggregate expenditure is shown when the sector labels intersect in this matrix. That's the expenditure by a particular sector. Now that is necessarily equal from the money that turns up in the recipient sector. And that's the whole idea about aggregate expenditure is identical to aggregate income. But I need to extend that today and say it's not just aggregate income, it's also net capital gains. Okay? Because that's where the capital gains come from. And I've just had another little thought that I'll need to systematize for next week on that very point. But aggregate flows, if you show them in dollars per year at a point in time, I showed in lowercase. And the only stock I bring in, of course, is the stock of debt, which only turns up when you're looking at lending in the first place. I've got that in uppercase. And the first case I gave you was you had three sectors, sector one, sector two, sector three. Now think about that, consumption goods, investment goods, asset markets. Plenty of sense to do it that way. Any other sectors at all, it's just an arbitrary set of sectors. I'm actually going to write an article for my Forbes column finally after months of not having time to do that. When I'm going to use this for Dick, Tom and Harry, or maybe Dick, Tom and what's his name, Donald, so to show the flows in finance as an example for less mathematically skilled readers. So what you've got is minus A plus B is the amount of money that sector one spends on sector two and sector three. And this is all in dollars per year. So you could actually have the aggregate expenditure in an entire economy represented this way. Because the aggregate expenditure is the diagonal. You take the negative of the diagonal, and that's aggregate expenditure in the economy, and it's necessarily equal to aggregate income, which is the sum of all the off-diagonal elements. Okay? That's the simple point that I made last week. And I'm going to make it, I've said several times today. Now, if you're putting in loanable funds, what you now have is sector one is borrowing money from sector two. One thing I haven't shown on the diagram here, but I'll do that in a later time, another time when I present this argument, is that the goods transactions are ones that go horizontally, okay? But the financial transactions go along the diagonal. In this particular case, if you're borrowing money from one sector to another, there's a flow along the diagonal as well as a flow between the sectors. So I'm using rho for the rate of interest now, just to make it different to the letters for the flows. And what you there have is that sector one is spending D minus L dollars per year on sector three, because L dollars per year is being lent to sector one. And then sector one is spending B plus L dollars on sector three and paying rho times L interest to sector two. Okay? So the accounting in terms of the sum of every row is still necessarily zero. If you now think, well, the point I just actually occurred to me a moment ago, if I made this consumption good, investment good, and asset markets, okay, then the vertical, the sum of the vertical is net income for each of those sectors. Okay. Now, or net accumulation of financial assets. Now, in this case, that can be greater than zero. That can be greater than zero. This, therefore, has to be less than zero. Okay, because the sum is still overall zero. Okay, so your vertical is the net income for each sector, income in excess of expenditure. But the horizontal is expenditure of each sector is equal to the income that generates for the other sectors. Okay, to cover all that. Pardon? The second column. The second column, this one here. Yeah. Now they can all be different from zero. Okay, the columns, because they're talking net accumulation of financial assets, effectively, they can all be different from zero, but the sum of them has to be equal to zero. Okay. So there we just do the same story. We take the negative of the diagonal. What do we get? And this is the thing which I don't think neoclassicals who have this model in their minds are actually aware of this, that it ends up showing that financial transactions, interest payments, become part of aggregate expenditure, and they're also they're not net expense. This is one thing it's very easy to fall and think that must be net. They've only shown the loan interest there, but if I had the deposit interest, that would be subtracted. No, it's added. Okay? It's gross financial transactions. This is why we talk about gross domestic production, because net domestic production is zero in this world. Okay, goods in, goods out, and that's what people are saying here as well. That the gross is zero, but the net is zero, but the gross is positive, and the gross is what you're trying to identify. Now there's aggregate expenditure. This is aggregate income. Also includes gross financial transactions. So that's something I don't think those neoclassicals are used to. When you bring in endogenous money, what I have is sector one is borrowing $L per year from the banking sector, which I've ignored in the previous setting, but I've got it there in terms of the structure of the table, and then pays interest of rho times L to the banking sector. So we now have an outstanding stock of loans, which I couldn't show the loans on the previous table because the loans were an asset of sector one and a liability of sector two. They were nothing to do with the banking sector. And this is looking at from the banking sector's point of view. Now I've got the banking sector here, so it's making a flow of new loans of $L per year to sector one, and sector one is using it to buy with sector three. Now that could be consumers borrowing money to gamble on house prices. Okay, that's the sort of possibility. But now two things happen. First of all, you've got when you now look at the sum there, then you've got that's the L, the flow of new credit dollars per year doesn't cancel. Okay? It's not a flow between sectors in the economy. It's a flow of money being created by the banking sector and then being used as part of expenditure. So it's part of aggregate expenditure. So you've now got credit turning up there. And credit also turns up as part of aggregate income. But that aggregate income can be net capital gains as well. So you've got to tie together finance and economics. You can't separate the two. So there's credit, the flow of the new loans in dollars per year, turning up as part of aggregate expenditure and aggregate income. So it plays an essential role. And if you leave that out of your macroeconomics, you're not doing macroeconomics. You're doing a mythical world where banks don't exist and where debt doesn't matter. That's not the planet we live on. So the basic point I made last week is this. There are two sources of expenditure: the turnover of existing money and new expenditure, which can go on both assets and goods and services, which is financed one-for-one by the creation of new debt. That's why it matters so much. Now, Minsky understood this, and what I've been trying to do and I implicitly understood this when I read Minsky for the first time, which is back in 1987. But then it takes a hell of a long time to get from that to actually understanding how he actually can bring the role of credit in to macroeconomics in a fundamental way. How does it actually turn up? And what Minsky had there is he argued that if you're going to have increasing aggregate demand, where you don't have falling prices at the same time, then you have to have current spending plans. And notice this current spending plans summed over all sectors need to be greater than current received income. Now, that's a particular argument I've been developing and trying to formalised for the last decade and a half. And he said that some market techniques must exist by which aggregate spending in excess of aggregate anticipated income. Now, he's talking here about a gap between the income you think you're going to get, which is sometimes what you spend, and the income you actually get. How can it be financed? He said that it follows that over a period when economic growth takes place, at least some sectors finance part of their spending by emitting debt or selling assets. Okay, so Minsky had this verbal insight, and the thing is, it's how do you turn that into a logically watertight statement you can put in mathematical form? Because the confusion that's come out of not being able to put this in mathematical form is immense. And this is one of the reasons that I'm a fan of doing mathematics the right way in economic theory, because there's been 30 years, you can see the date on this thing, 63, 50 years of confusion over this in the post-Keynesian literature itself, not just between neoclassicals and post-Keynesian, in the post-Keynesian literature. Richard? Yes. Oh, okay. You're doing the Donald thing. I thought you were going to say something. Okay. Just making sure. Okay. So what he says, for such planned deficits to succeed in raising income, have to be market processes that enable these plans to be carried out without offsetting reductions in the spending plans of other units. Now, that's what I've shown you in that particular piece of logic. That's only possible if banks are creating money. It's not possible if lending is between one non-bank agent and another. That's why that's a huge distinction between loanable funds and endogenous money. They said even in the expectation will be that some sectors have larger surpluses than anticipated, but on the whole they have to be a result of a rise in sectoral income rather than a reduction in spending below the amount planned. Okay? So you can't get it by reducing spending. This is the point I want to make in my Forbes article when I finally get around to writing it, hopefully next week, is that the huge fallacy in the mainstream way of thinking about the role of money in the economy and therefore government spending is that individuals can save, therefore we can all save. Now, if I show on that table, and I'll try to do that exercise for next week, if I show one sector actually trying to reduce its spending, it's also reducing its expenditure. Now, if you're doing a single isolated individual doing that, you can therefore increase the net sum. So you actually get, and you add up your column, you'll get a net accumulation or increase in your accumulation of financial assets. But you add up the entire matrix, looking at the expenditure or the income side, there'll be a necessary fall in expenditure and income, precisely the amount the person reduced their spending by. So if the government does this, you reduce income. Or if a huge sector does it, you reduce income. You don't actually save money in the aggregate, because to save money in the aggregate, you've got to create money in the aggregate, and you can't create money unless you're a bank, okay, or a government. Okay? So this is a huge fallacy in that sort of thinking. But here's, again, Minsky carrying on here saying, this to take place, spending has to be financed either by portfolio changes, which increase circulation, as he's talking about a change in velocity, or by the creation of new money. So Minsky, and I find this regularly when I read him, there's a depth of understanding there, a true intuition that most other people don't get. This does come out of his period of being Schumpeter's PhD student. And actually, you actually see an article by Randy Ray recently, and of course he knew Minsky much better than I did because he was Minsky's PhD student. He said that Minsky deliberately chose Schumpeter, I think, over Alvin Hansen as a PhD supervisor because of the sort of insights he saw in Schumpeter on this front. Now, he couldn't quite formalise it, and he attempted to do this in his major book. Now, as I've said a few times here, I regard John Maynard Keynes as the only good book-length statement of Minsky's views. Stabilising an unstable economy, I find a bit of a mess. Krugman went to start reading Minsky, and that's the first book he chose. I wrote to him saying, don't bother reading it, read this JMK first. And he wrote a little blog post talking about the difference between the idea of reading Minsky and the experience of reading Minsky. And it's because he's reading the wrong book. Okay? He's much clearer on John Maynard Keynes. But he tried in a section called The Economics of Budget Constraints. He tried to formalise this logic. And what he did is define consumption as wages plus some fraction of income from the ownership of capital. And there's confusing terminology. It says using D, which is, I'd rather use D for debt, or K for capital perhaps. But he said that's a fraction of income you're getting from that that you then allocate to consumption spending. And then he ignored debt finance consumption by workers, just to leave it out of the system. So he's really looking at C is wages. C can be wages plus income for capitalists, part of which they use for consumption. So W is consumption is all of wages, which is just ignoring workers have any other source, and maybe also ignoring the time lags involved in worker spending as well. Plus this alpha times D, which is income from the fractional ownership of capital, which was allocated to consumption. Then he defined investment as being equal to retained earnings times a leverage factor. So he's already taken out alpha out of there, okay? But he's saying investment is 1 plus some leverage factor times the earnings you retain, where Q is related to D. So his total budget constraint is say that total income is going to be income and expenditure is going to be wages plus this fraction of money spent by capitalists plus 1 plus lambda times retained earnings. And he then said, well, part of household income would also be available for finance investment. So he's got 1 minus alpha times D is used for consumption. This is income from capitalists. So 1 minus alpha times D is therefore available for investment or speculation. So he said, well, if the leverage fraction of investment 1 plus lambda times Q, if that's greater than savings, then you've got to be financing it using borrowed money. So he said, if lambda times Q is greater than this mu, which is the fraction that's available to finance investment, times that 1 minus alpha times D, then some investment is going to be financed other than by savings. Okay. So you've got to be this excess, and that's what he defined the excess, but lambda times Q minus that fraction has to be satisfied by some combination of an increase in the money supply or a decrease in money holdings or an increase in velocity. They're saying either you finance that by borrowed money or by turning over existing money more rapidly. And so I think you can still see the logic is still there, but it's becoming complicated to understand, isn't it? Okay. Now, he then attempted to formalize it using difference equations. And one thing that I'm fairly well known for in Post Keynesian circles is being a total critic of difference equation approaches. Anything involving period analysis, I'm very much critical of, mainly because there's three major reasons. First major reason is that if you actually define a model properly, then you have your equations T minus 1, T minus 2, T minus 3, etc., have to include the actual measured lags, the time delays or lags that you find between various things in the economy. So if you think investment is based on profits 1 year earlier and you're working in weeks, your investment now is to be a function of income in T minus 52. Okay? But then if you find empirically it's actually T minus 60, you've got to change your entire structure of equations. Okay? Now, who does that? Nobody. So what do? Everything's T and T minus 1. And therefore, what they end up doing is forcing consumption. When they say consumption is a lag function of income, they're going to say consumption is based on income last year. Has anybody spent on their income based last year? No way. Okay, so you distort the time dimensions of the whole model. But the most important one is the logical point of view, and that is that it's incredibly hard to identify changes because everything happens between the periods. During a period, everything's effectively held constant. Between them, they change, and you don't see it. And this intellectual problem, I think, is why we spent so long getting there. But you'll see this turning up in Minsky's logic here. So he's saying after the event, consumption after the event, ex ante, is going to be equal to consumption now based on wages the previous time period, T minus 1. Okay, Minsky's doing it. Wages, consumption based on wages last year, which is nonsense. Okay. Plus there's alpha times profit last year. No, but just forget about the last year, but it's showing that Minsky's falling into the same trap just by one of the poisons of thinking in discrete time, where it's not justified. I mean, one other reason that discrete time is unjustified in economics is,
Do you have any other option in the 60s?
Pardon?
There seems to be no other option.
It's a huge, yes, there is continuous time.
Yeah, but that's because we can have technology that allows.
This is 1963.
Exactly. So you can have to go off the balance sheet, and then the kind of primary data sources.
Well, the primary data sources, when you look at them, are basically telling you what the flows are on an annualized basis. If you look at the flow of funds, it'll tell you the change between 2 quarters, but you can then work out the change over a year, and then you can basically argue that that's a continuous rate of change over 1 year. The T minus the change in debt annualized, okay, can then be compared to the income on an annualized basis. So it's not impossible to process the data. And plenty of scientists were doing this when economists, I mean, you're doing fluid dynamics, and that's a huge part of where we develop the mathematics of continuous time modeling. You're sitting there measuring, what's the rate of flow of this river at this point in time? How many meters per second is the river flowing at? And then you're taking a cross section and saying, what's the area? What I'm measuring, and bang, you've got an instant calculation of the volume passing per minute per year at that point. Okay? Now, simple for the fluid dynamics in that sense to do it. And the mathematics they built was built on the fact that they could do that. But we've still, because we do record economic data in discrete chunks and estimate it as well, we've been trapped into thinking about it from the point of view of the data we collect rather than the nature of the system generating the data. And if you're going to understand a system, you've got to know what's generating the data, not necessarily how you measure it. Okay? Build your model on the system. That's what we should have done. And this is where, again, we're falling into. But I'll show you. It is. I take the point. It was harder back then, but the fact we've, again, like economics is still doing this 50 years later. Okay, the excuse is half a century old. Just like neoclassicals are still doing equilibrium 1.5 centuries after it was a decent reason. Yeah.
But just give you an intuitive idea of what that plan.
Well, it's just basically saying, let's say you return earnings are 100 million, and you invest 120, and lambda is 0.2, and you've borrowed 20 million. Okay, that's what it's really coming down to. It's using a ratio to talk about how much more you're spending on investment than your retained earnings. Okay. So the investment ex ante before after the event is 1 minus this lambda, and it finally gets an expression for income after the event. So ex post income is that expression. Don't worry too much about the maths because I'm going to point out that you can follow what he's trying to prove, but it didn't convince anybody that he was still right. Okay. So then he says for an income in period T to period so ex ante is before the event. Pardon me, ex ante before. Okay. Ex post after. So you say before the event, your consumption is based on what you think what your wages were last year. So you spend your planned spending is based on your wages last year plus your profit last year that's been distributed for consumption. Your planned investment is 1 minus your Q, and that's I've got to go back and check what he defined that as, but that's the retained earnings. Your retained earnings, and therefore your expectation of income before it actually happens, income expected in time period T is wages last year plus distributed profits last year, the fraction that's spent, plus the leverage, the part of expenditure minus the leverage factor. And he finally says, well, if you're going to get a rise for income after the event, so YT that actually occurs, to be greater than YT that was expected, then you have to have this leverage factor times retained earnings being greater than the amount that was used by households for financing investment rather than consumption. And then he says, therefore, investment has to exceed savings. Now, he's defining savings as a part of money you don't spend. That's a residual definition. One of the reasons I want to actually eliminate the word savings from economics, from macroeconomics. So for income to increase, the externally financed investment must exceed savings of households. And for that to be possible, we've got to have another source of money. Somehow money has to change. And he said it could either be money creation or a change in velocity. I think the latter's a bit clumsy, but I could allow that. He said, so since you got a proportion that was presumably made available for investment, you then have this explanation that leverage factor has to involve part which was available for financing plus this change in the money supply. And he then substitutes that the condition he had for the income to grow over time to say that the effective income to grow over time, the creation of new money had to exceed the fraction saved and not made available for investment. So he finally got this equation. Pardon me. I've got animated properly. I'll actually put the animation there properly because I want to... Why didn't that turn up? It is supposed to turn up. What have I got to wipe? Hang on, I'll just actually... I don't know why it didn't turn up there. I'll make it appear instead. Okay, let's see if that actually happens. Greater than that fraction for ex ante investment, ex ante income to be greater than ex post. And again, he's talking planned expected income greater than actual income the year beforehand. And like that didn't exactly help people understand what he's trying to reach. I could see where he's trying to get with it, but it's very confusing. And this is now part of a debate in 2014 with a guy called Brett Feiberger, who was criticising my attempt to another way of reaching a similar conclusion to Minsky. And I used Minsky's, I made a large song and dance about this particular Minsky article, my article, trying to bring up my logic. And he said, well, given those parameters, that's got to be a tautology. He said, why he's in aggregate matter, aggregate income. You could state them both separately using t and t minus 1, bringing back in time periods again. Now not as a part of the mathematics, but just attempting to logically understand what's going on. He says aggregate expenditure in term t exceeds it in t minus 1, and aggregate income in t exceeds it in t minus 1. And he then said that is just a tautology. He said you've got to use the time period qualifiers to make sense of this. And once you've done it, all that's being communicated is purely tautological form. So Minsky put all that effort into a tautology. Okay. Yeah. He was just trying to say expenditure and income this year is greater than last year without giving an explanation. He was trying to explain how it happened. He didn't necessarily get there. That's what he was trying to do. So I think it's a case of his mathematics not really reaching his expression. And when you look at the literature again over a long period, this is Giuseppe Fontana, who's one of the leading Post Keynesians at Leeds University, a good friend as well as it happens. And he's talking about the debates that then developed within the Endogenous Money Post Keynesian camp, what was called the Structuralist and the accommodationist theories of endogenous money. And he said we have this debate over when you, again, it's the way we try to represent what we're trying to understand. And a large part of this was done in diagrams. Now, has anybody here read Basil Moore? Okay. I do recommend reading Basil's first paper, The Endogenous Money Supply, in 1979 Journal of Post Keynesian Economics. And the way that what Basil did in that paper is to say that banks simply accommodate the demand that firms have for working capital. He's looking largely at money back in the days when banks did lend for working capital. So you drew a horizontal line for the money supply, doing it in a supply and demand type diagram. And that's what is then the debate around the slope of the line became the basis of the intellectual debate rather than what are we trying to understand here. It's the manner in which we represented it dominated how we try to understand the literature. And again, because that's my main point about period analysis. I think it actually stopped economists, not just neoclassicals, it stopped post-Keynesians understanding what they, in a institutional sense, got quite right about the nature of money creation and therefore what it did to macroeconomics. So he said if you draw a diagram, you have a horizontal line, that's the credit money supply function, that's the horizontalist approach, which is structural, saying that's what the structure of the economy is. Hang on, let's see, accommodationist or horizontalist. Okay, and structuralists come along and say, well, it can't just be a horizontal line. They didn't like the horizontal line. Got to tilt it somehow. So again, the representation dominated the debate. And he said, his Giuseppe trying to make the logic, but he then realises that he falls into a logical trap. If everything interesting has to happen between time periods. That's why I wanted to highlight this article. There's another one of his as well that I couldn't find in time that I think really does a better job of saying this, but it's the basic idea. He's saying, say, accommodationists, and that's, again, the people who are talking in terms of a horizontal supply curve. Well, that's just like a single period. They're aiming to talk about the process of money creation and circulation and destruction, and they assume that the liquidity, the preferences are given within that period, so nothing can change within the period itself. Okay, so nothing changing. When do you get the change? Okay. He said, where the structuralists are trying to have a continuation analysis of money. But again, and this again comes down to the training that even Post Keynesians have had. They've been trained in economics by neoclassical economists. Almost all the neoclassical models use time periods. So they still think in time periods as if that's how you do dynamic analysis. But if you learn from mathematicians, you use period analysis for things like red crabs. Heard about red crabs? Okay. Christmas Island, a little island off the coast of Australia. Good place for refugees to be tortured. I mean rescued. That island has a population of red crabs that all breed on the same day. And the reason they breed on the same day, which is the full moon, is that when they dump them, I don't know how many they spawn, but huge numbers of embryos and or whatever you call it, the tiny little thing they excrete into the ocean, it overwhelms the predators. The predators get a really big feast, but about 10% survive one day and 1% the day after that, and 0.1%, and that regenerates the population. So it's a survival mechanism for the species. Period analysis makes plenty of sense for analysing population of Christmas Island crabs. Makes no sense whatsoever for analysing money flows, but this is what's happening here. So they're saying with the structures, they're trying to say the changing nature of underlying conditions, and people might not get the money they want, disappointed expert, which is a valid thing to do. But he sees their approach as being not just a single period, but a series of periods. But then in trying to say where the change comes from, all the change happens between the periods, and they have no explanation of what happens between the periods. So he said it allows for changing expectations. And what you've got is a single period is, again, seeing accommodation as single period, structuralist is a series of single periods joined together to form a dynamic process. Then the single period is just a theory of money, a final payment. And you're ignoring what happens to liquidity preferences and so on. But structuralists are trying to explain the process of money creation and destruction over time, and they again, the way you do it, string together these discrete periods. But they then begin criticising the accommodationists here. And he says, how do you actually get the changes? How do they happen? And it's all because of this intellectual clumsiness of discrete time. And what I might do is, because I'm going to go into a bit of detail on continuous time thinking here, this is stage one of today's lecture. Let's take a break and I'll come back in 10 minutes and we'll go into a bit of the detail. All right, so back to this point about, that's a good discussion we've had about why discrete time is so clumsy. So that's because the interesting stuff happens between the periods, and even when you're looking at a stock flow consistent model with discrete time, that can miss out. So just think in continuous time, and it's much easier to do it. This is the crazy thing. The intellectual habits we have us working really hard to not understand what we're talking about. You actually use the right format, and the stuff drops out very naturally. So expenditure on one sector, on another is a flow in dollars per year. And if you even put 10, like you put a numerical example in a table, you're talking about $10 per year, not a single transaction of $10. Again, so the accountants can do the $10 stuff. The economists should be doing $10 per year. So all you need to do, you can then share that framework for the respective needs of reasons why it's worthwhile. So I'm going to go back to the three-sector analysis again. I'm going to take you through a different way of looking at it. And that's with sector one is, and I'm going to show you, this is just the same as before, spending $8 per year on sector two, B dollars per year on sector three, sector one, two is spending C dollars per year on one and D dollars per year on three, and then sector three is spending E dollars on one and F dollars. Actually, it should be lowercase f. Word got on the way and worked it up for me. Okay, well, PowerPoint did. You put that in a matrix. Then I'm going to call this SL for Say's law, obviously. And I've got the expenditure by sector one as sector one is taking the amounts of money of amount of any A dollars per year out of their account and transferring it to sector two, and B dollars per year out of the account and transferring it to sector three. And the same for sector two for sectors one and three, and the same for sector three for sectors one and two. Now, you know the idea of a trace of a matrix. That's the sum of the diagonal elements. So you take the trace of that, and that's going to be your aggregate expenditure, the negative of the trace, and the sum of the off-diagonal elements is aggregate income, or aggregate income plus net realised capital gains, which is, I'll talk about it probably more next week. So that's the negative of the trace. You just whack it into a mathematics program and say, okay, take the trace and then substitute for A plus B plus C plus D plus E plus F. Take that as the velocity of money, the turnover of existing money. I've got V, I showed a V times M there, but if I did that, that would be, actually, I wonder if I can actually do that. I might just check and see if it lets me get away with that. Possibly it does. Pardon me, as usual, little bug in MathCAD. Now I can bring that up, because I do want to show it as V times M. So if I can actually do that. V times M. Yeah, okay. So that's actually probably better. And we'll put it here as well. So that's velocity of money times its circulation. And that's now a better way of expressing what I've got here. Okay, that's V times M. Velocity of money times its turnover, times the stock of money. And that's Milton Friedman's world. Okay? Aggregate expenditure and aggregate income, just the turnover, the velocity of circulation of money times the stock of money. Now, loanable funds. Well, sector two is now spending D minus L dollars per year on sector three, and it's then lending L dollars per year to sector one. So that's the flow going along the diagonal of the matrix now. And then sector one is spending D plus L dollars per year in sector three, and paying sector two interest on the outstanding debt, which is capital dollar. Okay, we're doing animation on the wrong point. Again, you're taking negative of the trace of the matrix there. Do the same operation, you now get it showing gross financial transactions. I could elaborate that model and include interest payments if the bank was making any interest payments, because at the moment there's no reason for the bank to do that because it's just acting as an intermediary, so I can leave that out. And that's Paul Krugman's world, but he doesn't realise that it includes gross financial transactions, I think. I'd like to see him prove me wrong by quoting an old paper. Now, endogenous money. Well, sector one is borrowing L dollars per year from the bank and spending B plus L dollars per year on sector three and paying interest of R times L to the bank on outstanding debt. And then the bank has now got skin in the game. So the bank then is spending G dollars per year on sector one, H on sector two, and I on sector three. Put it in a matrix form, a more complicated matrix, 4 by 4 rather than 3 by 3. You take your trace and simplify. And I've now substituted for I, which, hang on. Did it actually do that properly? Looks like it did. It should be lowercase I. Let's just change that. Hang on a second. Not I. I went L, that's L, pardon me, and the reading properly is it's L. Okay, my apologies. That's the font that I'm using there. It's not I, it's L. Not capital I, it's lowercase l. So I'm saying substitute this for dt for rate of change of debt, which is what it is, and you get the result that aggregate demand includes change in debt. And aggregate expenditure, which becomes aggregate income and realised capital gains. So, logically watertight. That's one of the advantages of mathematical logic once you use the right form of mathematics, and it's only taken 50 years. So credit is part of aggregate expenditure and aggregate income. And that's what's been left out of, certainly completely out of neoclassical thought and not properly integrated yet into Post Keynesian, which is what I'm trying to do. And I've got a slide here that I didn't finish, so I'll jump over that one. So you now get credit matters. And this explains, again, I'm going over something I showed you last week, but I'll do it more slowly. When I build a model of loanable funds, and I did that live last week, I'll bring up a more complete model here. This is using Minsky's capabilities to generate a comprehensive model. What I've got is going inside the banking sector here. Again, I wish I could expand the scale of that. At the moment, we can't make the godly tables any larger. But I simply have lending being between the consumer sector and investment sector, repayment, of course, between the two, interest payments between the two, the payment of a fee to the banking sector, hiring of workers by the consumption sector, hiring of workers by the investment sector, the investment sector buying consumption goods, the consumption sector buying investment goods, workers consuming, bankers consuming, and bankers investing. Okay? And then they're all defined. The entire model is defined on the screen there. So I've got lending being, because the consumer sector is lending out money that's in the consumer sector's account, I've got lending depending upon what's left in the consumer sector's account, given the rate of flow at which the consumer sector is lending the money out. And so, because it's affected by two things, the stock of money that's left there and the rate at which that's lent out per year, which is using a time constant. I showed you the idea last week. And the rate of repayment depending upon the level of debt. Because again, that's again, the more debt the investment sector finds itself in, then the more it's going to be trying to repay back every year. So that's the basic logic there. Over here, I've got interest on debt being equal to the debt level times the rate of interest. Okay, simple piece of logic there. Interest payments, the fee that's being paid to the bank is a fee that it charges on the interest that's being earned by the consumer sector. And I've got money defined as being the sum of the various accounts. Consumption plus investment defined down here to give you income. So it's all just basically accounting for the flows. And if you simulate this model, and I'll put it up in high-speed simulation mode here, then what you get is if you change the rate at which loans are extended. So at the moment I've got in inverted commas loans doubling every 7 years. It's not quite doubling, but it's a factor of increase related to exponential functions. If I make that go to 5 years, notice the growth rate actually drops with a faster rate of lending. And then if I have repayment rather than halving the debt, inverted commas, every 9 years, let's make it much, much longer. Again, the increase in the level of debt has actually reduced the growth rate slightly. The reason being that the increase in the level of debt has put more money in the investment sector's account, and the investment sector, given the parameters I've used for the model, has a lower rate of turnover of money. Therefore, the demand, the actual demand in the economy falls. You can see the debt to GDP ratio is going through the roof, but what happens to GDP? Almost nothing. Okay. Now, if we then, I'll let the ratio, the amount has been running for 60 years now. GDP has been 200 for the whole way through because there's been no change in the money supply. Okay. And velocity hasn't changed because I haven't made aggregate changes to the other elements that determine velocity here, which include rates of consumption, rates of investment, and so on. If I now have a drastic slowdown in lending, so rather than loans doubling every 5 years, they double every 30, notice the growth rate increased, okay? Decline in lending, and then I have a huge increase in how fast debts are repaid, which again causes a spike in GDP, and the debt ratio plunges, and there's effectively, ultimately, after a bit of an increase because of the more money turning up in the consumer sector's account, where the consumer sector spends at a faster rate than the investment sector, a little spike in GDP, but it disappears after a while. So after 110 years, back to 200 again. Okay, no change whatsoever. Now, and I'll be slightly more thorough than I was last week. I'll bring up the consumer sector's view of the economy here. So there's now an additional asset turning up, which is the debt that's owed by the investment sector to the consumer sector. So that's an asset of the consumer sector in the loanable funds view of the world. So let's just now be realistic and say, well, I mean, I could leave that there and define another form of debt as bank debt. Okay? But I'm just going to say, well, let's just go completely from a loanable funds world where debt is just a loan between two non-bank agents, to completely the endogenous money world where debt is an asset of the banking sector. So what I can do with Minsky is I can delete that particular column. And once I've deleted it, several things happen. I've now deleted it as an asset, but it's still in the economy being shown as a liability of the investment sector. So here's now the debt which I've deleted is still in the system. And so are the operations of lending and repayment and interest payments. So they haven't been deleted. That's one of the beauties of the double entry bookkeeping approach. I've got rid of it from one perspective, but it's still in there from the other perspective. So let's now delete the operations because lending and repayment still occur, but they're not between the consumer sector and the investment sector. Therefore, they don't affect the consumer sector's books. So I delete the lending row, delete the debt repayment, delete the interest payment, and also delete the bank fee because the bank's making, I know banks charge fees. Somebody actually challenged me on YouTube about this saying, well, banks do charge fees. Yeah, I know, but I can include that later. I'm getting the bank's not charging a fee to the consumer sector for the money the consumer sector hasn't lent in the first place. Okay, so it's just an irrelevant part of the loanable funds model of the world. So I've got rid of that. Now I've still got it showing up as the asset of the debt liability of the investment sector. So I can bring up the banking sector now. And what Minsky does, amongst many other things, is it keeps a track of assets and liabilities. And this little, if you create a new row and say I want to put a new asset in there, this little down arrow is there to go and check and find any unallocated liability, which can therefore be an asset for the agent you're looking at. If I click on the down arrow, it shows me debt is the one asset of one liability in the model that hasn't been allocated as an asset to any other agent. So I click on D, and you'll notice the top two rows are lending and repayment operations, which are still shown on the bank's books for the investment sector because those payments are going through that bank account. Click on D, and lending and repayment are brought across and matched with that particular row. So I've now got that correctly specified. But of course, the interest payments aren't going anywhere now because they're not going to the consumer sector. They're still being made. Of course, they're going to the bank. So I now type over here minus INT to show it's an inflow that increases the equity of the banking sector. And then with the bank fee, if I delete the bank fee, I just get it out of the system. That's gone now from the system because I've deleted it from the consumer sector's row and I've deleted it from the banking sector's row. I need to show that the bank's assets equity is higher. So I've got -5, that I can now make that -15, and that makes that correct. And of course, the assets of the consumer sector are not 70, which is 60 for the initial amount in the deposit account plus 10 for the debt. Well, that's not an asset of theirs. That's now correct. And I'll just leave it at that point. I've got one more change I should make, but just to show that that's all I need to do to go from a loanable funds view of the world to endogenous money. If I now run the model again, then I get a positive growth rate. Even though I've got loans being repaid, I've got to change the lending rate as well. But I'll do that too before I start doing the simulation. So I want to go back to the same situation I started the loanable funds model with, where it's every 7 years to double loans and every 9 to halve them by repayment. We simulate there, and you get a positive rate of growth, you get a growing GDP, and as the amount of debt in the economy goes up, so does the money supply. And what you've seen is the logic behind why that happens. And of course, as it happens, I built this model years before, 5 years, I think, before I finally worked out the mathematical logic behind it, which again is where this sort of software helps immensely because I knew I was right, though I couldn't express it in a way that convinced other Post Keynesians. But I could do it in 30 seconds in Minsky, and I've taken slightly longer. To make it more correct, I've got the amount of lending based on the amount of money in the consumer deposits account. I should really just delete that and say it's actually based on the amount of debt as a stock relating the rate of change of stocks to flows to the flows themselves to rates of change to relevant stocks. You can make it more elaborate, of course, in a fuller model, which I do with my model of Minsky's financial instability hypothesis. I'll make it based on debt, and then you've got a more accurate model and the same basic story. Positive growth rate. If there's an increase in how fast loans are given, there's an increase in the rate of growth of the economy because you're creating more money, which is being spent through the velocity relationships that are in the system, the rate of turnover. And if repayment happens more slowly, again, your debt ratio rises and so does your growth rate. Okay? Now, that's completely inverting the dynamics I showed you for loanable funds, where an increase in lending reduced the growth rate. Okay? And this is saying that's why it's so totally wrong to leave this concept out of your thinking, which the Neoclassicals do, and again, which the Post Keynesians haven't fully incorporated yet. So there's a huge rate of growth, but there's a huge amount of money supply being created. Now, I'm not looking at any failings in the system which would lead to financial crises and all the money is effectively being profitably engaged. I'm not looking at changing. There's no change in income distribution going on inside the model here, in the sense that wages are rising as much as GDP is rising. Okay, if I had changing the amount of debt, changing the amount of money being paid to bankers, increasing the workers' demands for wages, then I'd have some dynamics coming out, but they're not in this model. That's the sort of thing I want to see you lot do over the time as you advance this approach to economics. The growth rate's gone off the scale. The growth rate is currently 16% per annum. And of course, that could be quite realistic if you're looking in nominal terms. Economies do grow at that sort of rate nominally, do on it maybe except when there's debt deflation, which is where we are now. Now, if I then have a rapid change from lending money to repaying money, then the economy goes into a slump. GDP actually falls. Your debt ratio might fall in this particular case because, and then if you recover back again, we got through that particular crisis and GDP starts to grow again. But if you're leaving that out of your thinking, you're just not understanding the macroeconomy. And that's what Neoclassicals completely failed to do this by the Loanable Funds myth, and Post Keynesians are getting there, but they have to properly integrate this thinking into their macroeconomics, which is what I'm trying to do. So that's where that comes from. So what you get is, so I've shown you the level of economic activity in nominal terms, and also then in its feed through with people's output decisions and so on, rises and falls with bank debt. And we've completely missed that in neoclassical economics. And it also explains why we've had a crisis. Now that I'm looking at the real world where these things do change the distribution of income, do change the amount you've got left over for investment, do change your investment decisions and so on, you have a crisis coming out of this because of a slowdown in the rate of growth of debt. Now, it couldn't keep on going forever for other reasons that even in that model you start reaching a ceiling, even though I'm not looking at income distribution effects coming out of the model, because in the real world you do get quite serious changes in distribution of income, and that does undermine people's capacity to pay the debt they've incurred, and you do get people buying assets based on rising amounts of money going to a market, which then disappears, the market crashes and so on. So aggregate demand in the economy is the turnover of existing money, V times M, plus credit. And of course, thinking about this, I'll be showing you a little numerical example in a moment, but I've got GDP growing in the model 10% per annum in nominal terms. Why is it growing? Not because these change, but because the debt you're taking on is changing the amount of M. Okay, and that'll turn up as well in a moment. So I'll give you an example of why it's not just why to get into a crisis you've got to have an excessive level of debt accumulated in the first place. You won't have a crisis when debt is low. So now it's not just the importance of credit as a source of aggregate demand and aggregate expenditure. It's also the dangers of too much accumulation of debt through credit in causing economic crises, which is where we are now. So you take an example of a low level of debt where the turnover of existing money. Now I'm using turnover of existing money to be strictly correct, but it's cumbersome. Okay, so what I'm going to say is GDP instead. Now that's making effectively saying, well, let's imagine that all of GDP is financed out of turnover of existing money, and all of new credit goes to buy assets. Okay, so that's equally a way of doing it, and that's what I do. I think in my new book I've done that as well. Imagine the GDP is $1 trillion a year, and that's growing at 10% per annum. And that, by the way, just to elaborate that comment about velocity of money, what we've seen as well is a trend for declining velocity of money over time. That's empirically been happening since the 1980s in America, and I think it's also even longer in the English situation. Well, what you can have is money growing at 20%. My voice keeps on going 20% per annum, courtesy of new debt being taken on. Can you hear that effect on my vocal cords? Feels weird, like I'm going through puberty again. If only. But once the money's in there, the rate of turnover money is slowing down as well. So you can get a 20% increase in the money stock, but a 10% increase in V times M because velocity is trending down. Why is it trending down? Because people are trying to put more money aside to pay the debt they've accumulated, therefore spending less, therefore your income is growing more slowly. This all feeds through. Okay, that's why I want you to get those interrelations in your minds. So let's imagine you have private debt in this economy being just 50% of GDP. Now that's about the level that America and England were after the Second World War. Okay. So if it's 50% of GDP, it'll be $500 billion. And if it's growing at 20% per annum, which again is a realistic set of numbers there, then credit that year is going to be 10%, or 20% rather, of $500 billion, which is $100 billion. So your total demand is going to be $1,100 million, $1.1 trillion, okay, which is $1 trillion from GDP, turnover of existing money, okay, plus the $100 billion that's borrowed into existence and then spent buying assets in this particular example. Now I've got the same rate of growth of GDP occurring last year as next year, so GDP 1 year later is 1.1 trillion. Now your debt slows down to growing at 10% per annum. It's risen from 500 billion to 600 billion in the previous year. So you're getting 10% of 600 billion, which is $60 billion. So you add the two together and your total demand is 1.16 trillion, which is still higher than the year before. Okay? But consider where we are now, where the GDP, again, same figure for GDP, same rate of growth, but private debt, 200% of GDP. Now, most countries in the OECD are stuck themselves in or near this situation. England's running at about 170% right now. America's running at 155, I think. Australia's 220, Canada's 215, China's 230%, Netherlands 240%. This is all realistic figures to be using. So you have debt, because GDP is 1 trillion and the debt ratio is 2 to 1. There's $2 trillion worth of debt. That's growing at 20% per annum. 20% of 2 trillion is $400 billion. Your total demand, therefore, in the first year is $1.4 trillion. Next year, same rate of growth of GDP, 1.1 trillion for GDP. Your growth of debt slows to the same as GDP, so your ratio stabilises. In other words, I'm not saying you have to have a decline in the debt ratio. I'm saying it's simply stabilising. What's the impact of the debt ratio stabilising on total demand? Well, credit's going to be 10% of 2.4 trillion, which is 240 billion. You add that to 1.1 trillion and you get a total amount of 1.34 trillion, which is 60 billion lower than the year before. So simply stabilising the debt ratio will cause a downturn in total demand. And that will affect both, in the real world, it will affect both goods and services markets and asset markets. So people are always looking for an exogenous trigger for a financial crisis. They say, what's the triggers? Is it because the central bank increases the interest rate? Or is it because investments fail? Well, yes, it can be both of those things, but it's simply the endogenous dynamics of debt can lead to this causing a crisis. And one little thing I haven't illustrated here, I can actually show that in the next half of the lecture. Because you're now looking at what's actually causing the downturn is a slowdown in the rate of growth of debt. Okay? Well, it's still positive, but the acceleration of debt's gone negative. And what you've got is a relationship between the level of debt, the rate of change of debt, and the rate of change is acceleration. And humans cannot get their heads around acceleration. I've thought about it more than most people, and I still get confused. Okay, but this is what's catching us. The acceleration is the key variable we need to consider, and we don't.
So
yeah,
like the point of inflection.
Yeah, the point of inflection off the point of inflection.
Yeah.
Okay.
Negative on the
Yeah, but it's negative on the derivative of the derivative. Okay. Okay. If you're going to have continuously expanding demand, where you have a credit-based system, and that credit is growing faster than GDP, then you've got to continue growing faster than GDP to continue expanding demand at the same level. If, on the other hand, you can potentially survive with credit growing at the same speed as GDP, okay? But any faster, then you're ultimately going to get to this point where it slows down again, and the acceleration effect will cause a downturn.
That's growing faster. No, it's steady. That fast rate is continuously
Yeah,
growing.
that's right. So this is why you have a crisis ultimately, because the conditions for the crisis is simply the debt has to slow. You will not get to an infinite debt ratio, okay? Because you get infinite debt ratio, what do you do with your money? You spend 110% of it paying back your debt. Sorry, you can't get there. Okay? So long before you reach that point, the residual you have. This is where I'm a critic of talking about savings, but I do want to talk importantly about credit and debt. What we call savings is the residual consumption that you don't. You don't actually spend on goods and services. But there's a limit for a lot of people below which you can't reduce that consumption. And then if you start if your debt obligations get to the stage where they're eating into that consumption, then bang, you just stop spending. And when you do, the economy crunches, and then that feeds through to the debt system as well. So we don't measure the turnover of existing money. We could actually, if you think about it, with the electronic systems now, we could work out when somebody shopped with cash or with a debit card versus when somebody shopped with a credit card, or when transactions were financed by taking out a loan versus when they're financed by using existing money in a firm's bank account. So we could actually measure it. We don't. The best thing we have is GDP, and because most money that's borrowed into existence is borrowed to buy assets, at least 70%, as much as 90% in different countries, then you can roughly add credit, which is change in debt, to GDP to get a rough indicator of total demand in the economy. It might be wrong by 10 to 30%. Okay, so it's empirically, it's a better guide than anything else we have at the moment. And with that, you can certainly understand the financial perspective, because again, I'm going to make an analogy here to say what I'm doing. You've got a poor approximation of the flow financed by existing money. We've got a good measure of the change in debt. And you can therefore, because they're both dimensioned in dollars per year, you can add them together. And my analogy here is like a flow on a river. You have a pump that's injecting money into or taking water out. It's injecting water into or taking water out of a river at a particular point. Then your flow in the river is going to be effectively turnover of existing water plus new water added in and out. Same sort of story here. You're adding things which are dimensionally consistent. And that's, again, that's the point of the stock flow thinking. The economists have not developed good systems for making sure they avoid that problem. Finally, Post Keynesians are doing it well and truly ahead of the Neoclassicals. So what I'm going to do is add GDP to change in debt, which is credit, to measure what aggregate expenditure is, and show you can, every crisis we've been through, you can identify it this way. So here's Japan. So the red line is Japan's nominal GDP. The blue line is nominal GDP plus change in debt, which is when they're both graphed on the left-hand side in billions of yen per year. The black line is credit as a percentage of GDP graphed on the right hand, with the maximum being 60% and the bottom being minus 20, because that's pretty much the range. Enormous range in some cases. And you can see that Japan's crisis, which began in roughly 1990, that's when the sum of the two peaked. And GDP rose a bit in the aftermath, but GDP plus credit was trending down. And since 1990, nominal demand in Japan has never reached the same level again. Now, real output's risen, and real per capita has risen, because with declining demographics, they've actually had even I think in terms of demographics, there might be an increase in yens per head in nominal terms in Japan. But fundamentally, it's been stuck there since 1990. We're going on 30 years now. Okay? And if we'd actually understood this stuff, this could have been a warning to us. Let's do something different. Because this is why I see economic theory is so dangerous, because it's actually led us to ignore this stuff and say it doesn't matter. And look at the situation it's got the global economy into. Now, if you look at the aggregate, looking for the 5 years before the crisis, so I've done longer time analyses with more recent data, but credit was averaging 18% of GDP before the crisis hit. After the crisis, it's been minus 1.8 on average, sometimes positive, sometimes negative. What caused the crisis? The United States. And a much cleaner pattern, which is quite cute. It's nice. This is what I want. I prefer using the United States for lots of reasons. Better data, at the moment anyway, before they decide to destroy it. You never know what's going to happen these days, do you? And recorded for a longer time period. And just in terms of its actual behaviour, it's cleaner. You can see that credit was never negative for America from 1970 forward. In fact, it was only negative. I think the last time it was anywhere near negative was actually the early ends of deleveraging after the Second World War. But it's been positive all the way through. And even in the 1990s recession, which is what gave rise to Clinton after was it Reagan or Bush? I forgot which one it was. I think it was Bush. Bush Senior, one with the brain. Yeah. It was very low, but it didn't turn negative. And it hits a peak of about 15%. This is when America dates its crisis from, 2008. Well, what do you know? Credit goes from positive to negative, and you therefore have a downturn. And then when it turns around in 2010, the economy starts to recover. And now it's got a growing debt ratio. So before the crisis, looking at what's happening before the crisis hit, the average is 11% of GDP credit. After, 3.7. Now, not as deep as the Japanese situation, largely because they went to a very, very heavy stimulus straight away to stimulate people in the economy. What that stimulus did was enable people to be able to delever without going bankrupt, as many as would have gone bankrupt without government spending, but of course also encourage people to start borrowing money once more the crisis was over. Taking a look at some of the other countries around the world, you can see Japan sticking out like a sore thumb because it had its crisis back in 1990, and still, rather than learning from what Japan did and avoiding the same situation, look what the rest of the world did. So there's the United Kingdom is here. It peaked at just under 200% of GDP. Spain went through a huge boom, and this is why the Spanish government could look so good, according to the Maastricht Treaty, in the early days of the euro, because there was such a boom going on in speculation on housing, and largely actually a lot of this money was borrowed by construction firms, that the level of debt in Spain went from 90% of GDP to 220% over about 15 years.
They had government debt hardly going up at all.
It was declining.
Everybody thought
and this is again the modern monetary theory. Yeah, this is the modern monetary theory argument again. The sum of your trade surplus plus your government deficit plus your private sector deficit is zero. So if you have an enormous deficit being run by the private sector, which means they're borrowing large amounts of money from the banks, then that can be so great that combined with your trade deficit, it means the government's getting so much taxation revenue in versus so much less spending that it ends up recording a surplus and driving its own debt level down. But it's driving its debt level down because private debt's going through the roof. Yeah. So you can look at the actual period of the euro for Spain. It began at just over 100%. That's about 105%, and it reached a peak of 220. Well, that means over that period, which is less than 10 years, it's got an additional 1.1 times GDP. That's pretty easy way to be prosperous, isn't it? Ireland. Oh, look at Ireland. This is the Celtic tiger. Okay. We start, again, by the time the euro starts, they're running at about 1.3 times GDP, already pretty huge. From 1.3, oh my bloody God, up to 3.3. That's why they were a tiger. They weren't a tiger. They were a drunk tiger. Okay. Iceland was, I haven't got Iceland aside, but Denmark, I mean, you just look at it, and that's what I'm getting. You can imagine how irritated I'm getting having been pointing this stuff out for going on 20 years now, and still getting ignored by the mainstream over it. It's just the data screams this information at you, and you've got to. As one of my good friends, Tom Ferguson, who's the research director at INET, Tom had an article talking about political science that happens a very good empirical analysis, and I told him I'm going to steal this line because I hadn't used it, so I've got to attribute it to him. He said that it takes special training not to see this data. So, looking now at all these countries, you can date the beginning of the crisis to that turnaround point. I'm going further back from America because in 2006.4, I'm talking about the peak of the level of debt, the rate of change of debt declining from that point on. And it's gone from 169 to 150%. It's actually last year's data. It's now 152, 53. The UK, all of them are now stuck at an extremely high level of debt. And Ireland is still, Pardon? No, it's not austerity that's caused that debt level to go down, because America's debt's gone down more than most. Pardon? Well, the economy's gone down by as much as austerity in most of those countries. The American, the government private debt's gone down, the government debt's gone up. Okay, so that the compensating increase in government spending back into people's accounts again, and then they can afford to delever, and GDP grows. Therefore, the debt ratio falls. As countries going for austerity, you often find the debt ratio has risen. I mean, Ireland. That's not the most recent data for Ireland. I'll bring up Ireland's data in the next when we have a discussion, and it's actually gone through the roof again. Okay, and Greece is higher as well. I mean, it's total failure. The Netherlands still stuck at an extremely high level. Ditto for Denmark. Now actually means last year, by the way. So I need to bring that up to date to some extent. So what you've got when you now look at rates of change of debt, which is credit, you see that having been incredibly high before the crisis, in some countries, Ireland is just crazy because it's a tax dodge economy. And I think there was some huge airline purchase that went through some company's books, and that recorded a gigantic change in its debt level. So I've given up on trying to measure the Irish data seriously. But the real economies, like the American, you can see that decline, and the Japanese, and to some extent the Spanish and Netherlands, you can see that decline in credit-based spending. And that's why we're in a slump. Credit demand is going to remain low. So looking at the 10 years before the crisis, America was averaging 10%. It'd be slightly higher than that now, but because, like I said, this last year's data, I'll take the table later. The UK from 13.75 to 2.5. Japan, again, talking slightly different timing than what I showed in the previous chart, 15.8 to 0.2% per annum. Okay. Spain, 17 to 1.8. Netherlands has actually gone up a bit. I call them Schrodinger's zombie as it happened, but they clearly go through it twice, the zombie effect, and Denmark equally. So all these economies are basically stuck in debt crises. Now, some countries managed to avoid the crisis. Well, they did it by borrowing more debt. And, yeah.
I'm just kind of thinking, rather than seeing private debt as a problem for the banking sector, that's a great asset because you have the real economy that then they're putting their liabilities out onto.
Yeah.
Or you've got a kind of bloated financial sector that then is able to drain the rest of the economy.
Yeah.
Rather than seeing private debt as a failure of governance for the banking sector, it's great.
Well, it's great for the banking sector. It's wonderful.
Kind of position itself in the middle of the heart of the economy and then can kind of drain off the back.
This is why Michael Hudson calls them the parasite. They say basically that the parasite ultimately killing the host. It's one of Michael's book titles. And the idea is that it's this form of, effectively, it's parasitism, okay, which we mistakenly think is productivity. And you need to see, well, actually, it's certainly Schumpeter's vision of what bank lending should be for, which is where banks provide money for entrepreneurs, is a valid, creative use of that capacity to create money. What we're seeing instead, of course, is creating money for asset bubbles that collapse. And then when they collapse, the economy goes down and the bankers end up owning a large share of something that's growing very slowly. So in that sense, they're parasites that actually end up damaging the host. It's a bit like it's a tsetse fly form of parasitism. You get the blood from the cow, but the cow's pretty sick. Okay, and that's the situation we're in. It's more complicated again than that, but I think you can argue they're abusing a social privilege. Because creation of money, and this is one thing I've again bringing up the double entry issue, it ain't magic that does that. It's double entry, and it doesn't take brain power to do it. It takes a banking license. And where do you get a banking license from? You're authorised to be a bank by the state. It is then a social privilege you've been granted. And if you abuse the privilege, or the privilege itself damages the system, we should attenuate it, which is why I'm arguing for a debt jubilee. Let's take a bit of a break there, because that's a time for a bit of a conversation. And I was actually just checking to see what I've got. I might finish off on these charts because then we have a bit of a free-running discussion. But that'd be okay. We'll have about 40, 50 minutes to chat about this afterwards. So there's a range of countries that managed to avoid the crisis by continuing to borrow money. There's a slump in borrowing at some point around the crisis, almost without fail, but they then got enticed back into such things as the first-time. They call it the first-time owners boost. In Australia, call it the first-time vendors boost, because what it did was give far more levered money to the people selling a house, because they gave government money to people buying their first home, and then the banks multiplied that by a factor of 10 and up go house prices. On the UK, when they copied it, they called it help to buy, called it help to sell. But you're going to have a crisis for that simple reason: you cannot continue borrowing forever. There'll be a point where you start reaching a ceiling level. It looks like but for most real economies, and I don't regard the Irish as a real economy, you're looking at about between 1.7 and 2.5 times GDP, something in that range. And for that shame effect that I showed you in that numerical table, in that range, a slowdown in the rate of growth of debt will cause a drop in aggregate demand, and then you'll have a crisis. So just looking at the countries with a low debt ratio, so this is just again the same basic example. I'll give you the spreadsheet later. Making that example there of a country, if after 7 years its debt level stabilises, when it's got a low level of debt to begin with, and you've still got positive demand growth. If a medium debt ratio, again, I'd go through this more slowly if I hadn't actually already covered the other instance for you. What I've basically got of just a simple spreadsheet, I've got this growing at 10% per annum all the way through. I've got debt growing at 20% per annum until the final year, and therefore the debt ratio stabilises in the last 2 years. Credit being the change in debt every year, which of course drops in the final year when the rate of growth declines. Add the two together, and you then see the change in growth. And of course, as the growth, one thing about a rising level of debt compared to GDP, while GDP is still rising, is your growth rate will rise. It'll look like good economic performance for a while until the debt stops rising, then you go negative. In this particular case, where I've got a debt ratio of 100%. Okay. Now, when you take a look at the situation which is closer to where we are now, where the debt ratio, I think on this thing I've got it at 125%, then you get a more serious slowdown in credit and a bigger fall in debt. And that's only 125%. You make that 200%, a bigger change again. So you can now use that to say, well, what's likely to happen to these countries when they start getting in trouble? And these are the ones that managed to avoid the crisis. You can see there's the global financial crisis. Now, all these countries have got a higher debt level ratio afterwards, and some of them just continued borrowing right through. So Sweden went from 1.6 times GDP to 2.4 straight across the financial crisis. China had a decline, but then a huge increase. Korea, and this is a surprise to me, I didn't actually realise this, I looked at the data, has had a rise from about 1.4 to more than 2 now. The Australian situation, the debt started to go down a bit, but then both private sector borrowing for housing speculation, but also for investment in the mining sector, that rose as well. And Canada pretty much rose all the way through. So these are some of the countries that I think are certain to have a crisis in the next couple of years. And you're going to look at their debt ratios and what credit has been as a percentage of GDP as of the last year. This is why Carney's economic management looks so good, because credit was growing at 29% of GDP. That's China, pardon me. Canada's 13%. But yeah, that's the huge rate of growth of credit, the rate of growth of debt, which is credit. inject into the economy, they'll look like they're booming.
But who owes that money to do it?
Oh, that's a lot of the banks are state owned.
Yeah. So
Okay.
kind of when that money to yourself.
Yeah.
What is the kind of aggregate?
Well, the aggregate is still there, and the private sector is still in debt and still go bankrupt. But
could they
they could do the debt jubilee much more easily in other countries. Yeah, they could do it much more easily.
So it can go and then they can wipe it out.
Yeah.
And go back to.
Yeah, they could, and I've got a feeling they will when they realise they're in a crisis. So Canada, this is Canada's story. Let's see, what have I got here? Australia. I'm actually getting a slight pleasure out of the Australian situation because I know the Prime Minister down there from my university days. I always regarded him as an egotistical dickhead, and I won't be the least bit sorry to see this collapse on his watch. And then China. Now, China's huge. I mean, let's look at the before the crisis hit, the maximum rate of growth of credit was about 30% of GDP. In 2010, it was 40%. So they boomed their way out of it, but they've accumulated the debt level beforehand, and they've got to have a downturn at some point. And the United States, just I want to give you a long-term perspective now, because this is something which I can actually criticise, in a sense, modern monetary theory, in a sense, Minsky as well. You can't just see the government as a stabiliser. If what it does encourages a rising level of private debt as well. So if you look back at the pre-1930s period, the government was so much smaller than the private sector, of the order of 5 and 10% of GDP, that it couldn't counteract what the private sector did. And there were slumps where there was negative credit quite regularly, which meant your debt level fell back down again. But now that it's as big as it is, like 30% of GDP after the crisis, it stopped credit going negative every single time it got close until 2007, when it was just too big for it to stop. So in some ways, what government behaviour has done is encourage an explosion in total debt. And what we need to do is ways of reducing that debt. Okay? I'm not totally in the MMT camp about just let the government balance everything. No, we've got to look at the what it does to encourage the private sector as well, which itself can be destructive. England's a fascinating story. The panic that's going on right now about the level of government debt running at roughly 100% of GDP after it began the post-war period at 340% of GDP and trended down because GDP is growing much faster than government debt was growing. Government debt was still increasing most of those years, yeah.
Has anything changed in how the kind of government services that debt? We're in the kind of war period. Was it just the Bank of England by advance or just do it itself?
Yeah.
Now it's trying to do it through it.
Which they can't do because you can't borrow pounds in the national currency market, you borrow dollars. And actually what you're doing is paying for internet purchases. Yeah. But the large part of what you had the rate of growth of the GDP in nominal terms was much higher than the rate of growth of debt in nominal terms. So it was actually inflation that the main thing that brought that debt level down.
So wasn't that national currency handing it over to America?
Yeah.
Why?
Yeah, you guys become the reserve currency. Yeah. No, by the way, the one thing is this is the notice this is going right back to 1880, and you can see that the level of private debt in England never reached even 75% of GDP for the century between 1880 and 1980. After Maggie Thatcher gets elected. Okay. It's incredible how obvious that. Pardon? Yeah. Yeah, I've got. This is actually relying on again some excellent work by the Bank of England, which has taken the data back. Hopefully, they might have even gone even further back with a bit of luck. That's looking at the three major national economies, and you can just see historically we've never been in this region of high private debt ever before in the history of capitalism. So what we're going through is something we simply can't use previous experience for because there is no previous experience. The nearest was the Great Depression. And what got us out of that was writing the debt off. It was a messy way of doing it. I think it was called the Second World War. We can't afford a third World War. We need to find some other way of getting that debt level down. And now, this is England. As I said again, that's a remarkable increase. We're at 1.3 times GDP in 25 years. No wonder. Looked like the finance sector was making everybody prosperous at that stage, but it was all a bubble which has come to an end.